Hey guys, Brett Alegre-Wood, author of the best-selling book, The 3+1 Plan, and chairman at YPC Group. So today what I want to take you through is pretty much what's happening with the capital gains tax, particularly for overseas investors and how that affects you. There's lots and lots of emails been flying around saying you have to get RICS valuations done, this is what it's going to cost, it has to be done on the day, and all this sort of stuff. A lot of it's misinformation, a lot of it is aimed at instilling fear and making you basically pay up for a RICS valuation. Now, the reality is I do think that you should be doing a RICS valuation, but I'm going to explain your options, because you do have options, okay? Even though most people aren't telling you what they are and aren't telling you the actual thing that's happening. So let's start off by doing this. So first of all, as of all properties that are owned by overseas investors or non-residents will be liable for tax capital gains after the 6th of April 2015. So sorry, from the 6th of April 2015. So basically what that means is if you get a valuation at the 5th of April, okay, it means that you have a baseline, if you like. So up until any time before that, any growth before that, you will not pay capital gains tax. So if you bought the thing for 250, okay, or 200,000, and you get a valuation it's worth 250, that is the baseline. And then if you sell for 580, you'll only pay capital gains tax on that amount, not from the 200, okay? So don't worry about any gains that you've made so far. And obviously it's in your best interest to get the valuation up as high as possible because that will decrease your tax. But the question is how do you do that? Now, the interesting thing is look, HMRC, basically, the issue around this is this baseline figure, okay? So if you come to sell the property and then you come to calculate the tax and HMRC says it's worth 300,000, okay, you say it's worth 325, there's a $25,000 difference or pound difference. Now that difference, the reality is what that means is at 28%. Now, there's different rates and there's allowances and all that sort of stuff, but let's just forget all about those right now, okay? And what I'd say is speak to your accountant about your specific instance and how that affects you. But basically, 28% by 25,000 is £7,000 extra tax that you will pay, okay? Unless you can prove to HMRC that the place was worth 325 at the baseline, which is the 5th of April 2015. So, what are our options? Okay, and there's basically three options. So the first option is you do nothing. You do nothing when it comes to arguing with the HMRC, and understand you may not have to. You may put the figure of 325 in there and they may agree with it. They may not argue with it. Okay, in which case you got away, you save yourself potentially £500. Okay, and remember the other thing is for those with multiple properties, this potentially is £500 per property. So I've got one client who's got 20 properties. We're talking about £10,000 of expense to pay out. But the downside is potentially that you may actually save, or you may save a lot of tax, a lot more than that. So do nothing. My suggestion is that's not a good idea. At the very least, you need to do what's called a market appraisal, all right? Which I would be going on to. Now, this is if you want to do it. There's different types of market appraisals. You can go on to Rightmove, you can go on to Zoopla, you can go on to On The Market, you can go on to all these sites and download as much information that supports your case, okay? And then file it away, and hopefully when it comes to arguing with HMRC, if you have to, if they actually question it, then you can present all this and it's the basis for an argument. Now most of that style of research is what these guys will do, the RICS surveyor will do anyway, right? Royal Institute of Chartered Surveyors survey. This is the duck's guts, okay? This is the be-all and end-all. If you get one of these, which is going to cost you about £500, okay, inclusive of VAT, all right, and it varies. Some people, there's not too many lower than that. I've seen 600, 650, and it's a sliding scale. So depending on the price of your property, it may even go up higher. But this is going to be acceptable by HMRC. They really won't argue with this. Unless it's wildly out. But the reality is that's unlikely to happen with a RICS survey, okay? So this is, if you like, the safe option. Pay $500 and then be done with it, okay? Don't even think about it. When you come to sell it, whatever that valuation said is what it is, okay? That's the thing. In the middle is this market appraisal where you can jump on, do lots of research, or, and that's where I say free, or if you want, you can get someone like Easy Track or a letting agent, and they'll put together a report, okay, pretty much a market appraisal for you, costs you about £200, okay, and then you've got all that data which you can then present to HMRC. Will they accept it? It's anyone's guess, okay? So there are your sort of three options. What do I suggest? I suggest RICS, okay? And if you want to, speak to EasyTrack. They'll be able to organise it for you. We've got a number of valuers on board that we can bring on. And the more we get, okay, in particular developments and things like that, and the cheaper the price is. But you're looking around, just act as if it's going to be £500 inclusive of that, and you'll be pretty much on the mark, I think. Unless you've got some higher end property, you know, up above probably 800,000, that sort of stuff, then you're going to be paying more than this. But if you work on £500 per property, that's going to pretty much do it. All right. So guys, hopefully that's explained it, and hopefully that's sort of, you know, made it really, really clear. Now the decision is up to you. Do you take the risk, okay, and do nothing? Do you have absolute certainty and have the cost? Or do you find somewhere in the middle, you know, and still take some risk, but maybe you've got some argument, you know, when HMRC come calling, if they come calling, because they're not necessarily going to argue with what your valuation is, okay? So your decision, you know, by all means chat to the team, by all means, you know, do some research, look at different options, but really this is what the option is going to come down to. Okay guys, have a great day, and remember, live with passion.